Let's imagine for a second that you have the worst luck on the planet when it comes to investing. Seriously, every single time you have money to put into the stock market, you don't invest on some random Tuesday. Oh no, you somehow manage to wait patiently until the market hits a brand new, record breaking, confetti in the sky all time high. And then, only then, do you put your money in. You'd think this person is financially doomed, right? A perfect example of buy high, sell low. But what if I told you that even this supposedly unlucky investor could still end up a multimillionaire? We're going to walk through a little story that shows exactly how this is possible, and in the process, we'll bust one of the biggest and most expensive myths in finance. What we'll find is a surprisingly simple and much more effective way to build wealth. Let's be real, seeing headlines that scream, "The market just hit another all-time high," can be terrifying. For a lot of us, it feels like showing up to a party just as the lights are about to come on. Your brain starts yelling, "It's too late! I missed the boat! A crash has to be right around the corner!" This feeling, this fear of heights in the market, is one of the most powerful and paralyzing forces in personal finance. It keeps more people sitting on the sidelines, losing spending power to inflation than almost anything else. This fear basically creates three types of people. To see the true cost of this fear, let's imagine them in a quick story. First up, we have our main character, unlucky Leo. Leo has the worst timing you can imagine. In our experiment, he invests a chunk of money on the exact day the S&P 500 hits a new peak, often right before a huge crash. Think just before the meltdowns in 1987, 2000, and 2007. Just the absolute worst moments in history to jump into stocks. Second, we have savvy Sarah. Sarah is a market timing genius. She feels the same fear as everyone else at the peak, but she's got nerves of steel. She holds her cash, waits for the market to crash, and only invests at the absolute bottom when everything looks its worst. She is a perfect market timer. Finally, there's cautious Chris. Chris is like a lot of us. He's spooked by the headlines, paralyzed by the fear of buying at the very top. He decides the safest move is to not move at all. He just leaves his money in a savings account, thinking he's protecting his cash from the crash that feels like it's just around the corner. So we have the unlucky but consistent investor, the perfect market timer, and the fearful saver. Over a few decades, who do you think ends up with the most money? The answer might surprise you. Before we get to the results of our story, let's talk about the data. The fear of investing at an all-time high is a gut feeling that what goes up must immediately come down, but the facts tell a very different story. Researchers have looked at this for years. While the numbers change depending on the study, the conclusion is always the same. Historically, investing at an all-time high gives you returns that are, on average, just as good and sometimes even a little bit better than investing on any other day. One analysis from Schroders looked at market returns all the way back to 1926. They found that in the 12 months after the market hit a new high, returns were actually higher than when the market wasn't at a high. How is that possible? Because all-time highs aren't a fluke. They're a normal part of a healthy, growing market. They don't just happen out of nowhere. They tend to pop up in clusters during strong periods of economic growth. A healthy market doesn't just hit one high and then collapse. It often hits dozens of new highs as it climbs. Waiting for a dip often just means you're sitting on the sidelines while the market keeps going up without you. Okay, now back to our three investors. Let's imagine they each start with the same amount of money and invest over 40 years, a period that includes some of the worst crashes in modern history. Of course, in our perfect little story, Savvy Sarah, the market timing wizard, does the best. Her magical ability to buy at the exact bottom gives her the biggest portfolio. But here's the real shocker. Who comes in second? Not cautious Chris, who played it safe with his cash. It's unlucky Leo, the guy who only ever bought at the peak, sometimes moments before a crash. Despite his terrible luck, his portfolio still grows into a huge sum, completely dwarfing what cautious Chris was able to save. And poor cautious Chris? He comes in dead last, by a lot. His fear of losing money in a crash meant he guaranteed he would lose massive spending power over the decades. He chose guaranteed slow losses over the possibility of temporary market drops that historically have always recovered. This little story proves a huge lesson. The biggest risk in investing isn't always buying at the wrong time, it's not buying at all. So, why did unlucky Leo, our poster child for bad timing, still do so well? The answer is in the most important saying in all of investing. It's about time in the market, not timing the market. Even though Leo bought at the absolute worst moments, the key is that his money was still in the market for the long run. It was there to catch the powerful and often shockingly fast recoveries that happen after a crash. It was there to soak up decades of dividends, innovation, and economic growth. He had to have the stomach to watch it fall, but because he stayed in the game, he also got to experience the incredible growth that came after. This is backed by research on the cost of missing the market's best days. While specific numbers change over time, studies from firms like Hartford Funds have shown that if you missed just the 10 best days in the market over a few decades, your total returns could be cut by more than half. Miss the 20 best days, and your returns drop off a cliff. And here's the crazy part. Many of those best days happen unexpectedly, often during scary times right after a crash, when most people are waiting on the sidelines for things to calm down. The person who stays in cash, like Cautious Chris, is on a team that has historically always lost. The person who tries to be Savvy Sarah is playing a game that's nearly impossible to win. But the person who acts like Unlucky Leo, who invests consistently even when it feels scary, gives their money the one thing it truly needs to grow: time. The market's powerful long-term upward trend is a force that can smooth out even the worst entry points, as long as you just stay on the ride. If the data is so clear, why are we so terrified of investing at market highs? The answer isn't in a spreadsheet, it's in our own heads. We are all wired with a few mental glitches or biases that make smart investing really, really difficult. The first is loss aversion. For our brains, the pain of losing a dollar feels way more intense than the joy of gaining a dollar. When the market is at a record high, our brain doesn't see opportunity. It sees the edge of a cliff and a potential loss, and it screams, "Danger! Run for safety!" The second is regret aversion. We don't just fear losing money, we fear looking and feeling stupid. The thought of putting a bunch of money in right before a 20% drop is so embarrassing that many of us would rather do nothing just to avoid that potential feeling of regret. Finally, there's the gambler's fallacy. This is the mistaken belief that if something has happened a lot recently, it's less likely to happen in the future. After a hot streak of market gains, we just feel like a losing streak has to be coming. But the market isn't a coin flip. It doesn't have to correct itself just because it's been going up. As we've seen, all-time highs are often followed by more all-time highs. These mental traps create a huge gap between what the data says we should do and what our gut is telling us to do. Overcoming these instincts is the real secret to building wealth over the long term. So the lesson here isn't to just blindly throw all your money at the market every time it hits a new high. The lesson is to have a disciplined, repeatable plan that takes your emotional, panicky brain out of the equation. Here's a simple three-part framework that works no matter what the market is doing. First, for your regular, ongoing investments, like from your paycheck, the strategy is dollar cost averaging, or DCA. This is a fancy term for a simple idea. You invest a set amount of money at regular times, like every payday, no matter what the market is doing. Some months you'll buy when prices are high, other months you'll buy when they're low. Over time, it averages out your purchase price, and most importantly, it makes investing automatic, forcing you to be consistent and ignore the scary headlines. Second, for a big chunk of cash, like an inheritance or a bonus, the data is pretty clear. Lump sum investing usually wins. Research from firms like Vanguard shows that investing a lump sum all at once beats dollar cost averaging about 2/3 of the time. The reason is simple. Since markets generally go up over time, it's better to have all your money working for you for as long as possible. But this can be psychologically terrifying, so a practical compromise is a blended approach. Maybe invest 70 to 80% of the cash right away, and then dollar cost average the rest over the next few months. This gives you most of the statistical advantage of a lump sum while quieting that fear of going all in at a potential top. Third, practice systematic rebalancing. At least once a year, look at your investments. If your stocks have done really well and are now a bigger piece of your portfolio than you originally planned, sell a little bit of the winners and use the profits to buy the parts of your portfolio that haven't done as well, like bonds. This is just a disciplined, unemotional way to sell high and buy low, and make sure you're not taking on more risk than you're comfortable with. This framework, DCA for regular savings, a blended approach for big cash windfalls, and yearly rebalancing, is a system built for success. It replaces fear with discipline. If you want a deeper dive into the most important part of this strategy, I have a whole video that breaks down dollar cost averaging, which you can watch by clicking the link right here. The story of the world's unluckiest investor teaches us a powerful truth. In the long run, consistency is far more important than perfection. You don't have to be a market timing genius to build wealth. You don't need to predict the next crash or find the perfect day to buy. All you really need is a plan, the discipline to stick with that plan, and the courage to stay invested, even when your brain is screaming at you to run for the hills. The fear of buying at an all-time high is completely normal, but it's a fear based on emotion, not evidence. The data is overwhelmingly clear. All-time highs are usually a sign of a market that's healthy and growing, and the greatest financial risk for most people isn't a market crash. It's being stuck on the sidelines when it recovers and continues its long, powerful upward journey.